Well, it's great to be back with you guys here after being out of town for the last 5 or 6 days. Looks like there has been some interesting developments with the markets, largely downside pressure in the S&P 500 in recent days. However, today was maybe a sign of life or stability right around the 30-day moving average, and that comes even in light of some continued negative pressure from Facebook as they are hunkering down with their own mini crisis right now. Of course, Facebook, one of the 5 largest companies in the S&P 500 and therefore one of the most influential as well. So we'll take a look at that. We'll take a look at oil prices popping here today. ExxonMobil and a few of the other big energy players aren't really moving to the upside yet, but maybe some life there in the commodities world as well. But largely we've got markets kind of hanging on, going sideways, hanging on to that 30-day moving average, and so we're going to try to take advantage of that with a trade application example in the options world that actually makes money as long as the market doesn't go up violently or down violently. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's March 20th, 2018. For those of you that are new, welcome aboard. We're grateful to have you here. In the area on YouTube where it says subscribe, we would encourage you to not only click that, but click the bell icon as well, and that'll allow you to be alerted anytime David or I upload videos to this particular YouTube channel. Of course, we are very thankful to the rest of you loyal followers as well. Many of you have been with us for many years at this point. We can't thank you enough for that. If you're interested in more of these videos, one way you can let us know about that is by clicking the thumbs up button directly below the YouTube video. You can also leave comments for us down below. And in addition to that, we have a description area that has some helpful links, including one that would allow you to sign up for our daily email distribution list, which does contain stocks that are giving us new cluster signals, both overbought and oversold clusters, like we see with ExxonMobil here today. So if you're interested in that, be sure to sign up for our list. Now, in addition to YouTube, David and I are also big users of Twitter, so make sure you're following us there. My handle is @BrandonVanZee, all one word, and you can also follow the Market Scholars handle at @market_scholars, and while you're at it, make sure you're following David as well. It's @DavidSettle42, and of course, we're going to have that Market Outlook tweet pinned to the top of our timeline, so if you wouldn't mind giving us a like and retweet on Twitter, we'd really appreciate that. We'd really love to see that over 100 every single day in terms of likes on that. It does take quite an effort to make these free videos here for you guys, and so if you could do that and carry your weight for us, we'd certainly be appreciative of that. In addition to Twitter, we're also on Facebook. Maybe we should watch out considering some of the news we've heard about Facebook in recent days. I myself am a latecomer to Facebook, really only signed up here a couple months back. But anyway, we do have a presence on Facebook. Make sure you're checking us out there with that group web address that you see on the screen in front of you. All right, with that, let's do some analysis on the markets. So you can see here that I've got the S&P 500 pulled up in front of us. Chart background is pink, and so as a reminder what that means on this particular chart setup, it means that we have a bearish posture, at least on the S&P 500 here, which was up 4 points today. Not a big day, but at least stop some of that bleeding that we did see yesterday, which was a bigger sell-off day for us. You can kind of see where we stand here with today's candle. Bit of a spinning top type of a look and feel to it there. But as I mentioned in the intro, I think one of the somewhat appealing aspects of this chart right now is that, okay, we're now back to that moving average, right? Sometimes we overshoot on both the upside and the downside. Some of you have heard me refer to this as chop and slop, and I kind of stick to that right now until we see some sort of smooth trend establish itself, either to the upside or the downside. I'm going to assume that this is a sideways trending market. And so we continue that chop and slop ever since we had that big fallout back here late January, early February. And so that's kind of my mindset right now as well. I'm not expecting the world out of the market, and sometimes that happens, right? We were handed a gift as investors in 2017, an epic market for trend trading purposes. 2018 has not been that way. This has been a market that maybe has benefited those of you that are a little bit more active, those of you that want to do a little bit more swing trading, or those of you that are just simply selling time with various options contracts. And so we are establishing a mini level of support here at this moving average. Notice that that moving average color turned green here within the last day or so as well. And what that's telling us is that price right now is above a rising moving average. So hopefully that provides a little bit of stability there as well. So kind of a mixed message right now from the market forecast intermediate term line perspective. The posture remains bearish. So this green line down here is just tracking down just a little bit. Remember, you can read that in my label over here as well. It says intermediate term 69.35 and falling. And so if it's falling and it's below 80, then we know that that is a bearish posture. But if you look at that just visually, it's kind of flat as a pancake. So I wouldn't read too much into that at the same time. And so it kind of brings us back to what I was mentioning before. This is a flat market, feels a little bit more volatile, feels like it's chopping up and down a little bit more, but largely it's just a market that's going sideways till it figures out which direction it wants to go. So let's go ahead and take a look at our next chart setup here. This will be our 4-grid. A little bit more of a mixed bag here. We don't see that very often. Normally you find that the 4 indices here in the United States generally track one another when it comes to the posture setting that we use here on these market outlook videos. Well, we've got a mixed bag, and so we've got 2 charts that are pink and 2 charts that are green in this case. And so in the upper left, we've got the S&P 500. I already told you that's bearish, slightly, very bearish. I'm sorry, very slightly bearish. In the lower left, we've got the NASDAQ. That is bearish as well. And notice the difference in this one. The NASDAQ, which had been a leading index, you'll find that that green line just now fell out of that upper reversal zone. It had been above that upper reversal zone going all the way back here to March 8th. So we fell out of favor to a degree there. But, you know, those of you that are trying to combine indicators with price action, which I think it personally is a good thing. Remember, the market forecast indicator is just one of hundreds of technical indicators out there. It's not the end-all be-all. It's a good guide. It does a good job, but it doesn't do a perfect job. So we have to remember there is value in looking at multiple angles of the market. And what I would say about that is, you know, the NASDAQ still is trading above a rising moving average, which is why that moving average is green. And in this particular case, is actually a stronger indication than what I showed you up here with SPX. Remember, it just turned green. The NASDAQ has been green for quite some time. In fact, you see very few times where it had a red element to that moving average, and that's your 30-day moving average that we're looking at here, by the way. So you have to remember, markets need to breathe in and breathe out. This is a market right now, the NASDAQ, which continues to be bullish. It continues to be a leader. I still track a lot of new highs data behind the scene, and technology right now continues to lead the way from a new highs perspective. And so I don't think it's time that we need to give up on it yet. If this Facebook thing really starts spilling over and affecting a lot of other players within it, then, you know, we have to reevaluate. But at this time, what I see from just a purely technical analysis perspective is, yes, some indications of strain, and that's why we have that bearish development on the market forecast green line. But price by itself is actually holding up reasonably well, and I wouldn't be surprised at all if we start establishing some support in this area right here. It's done it in the past. Now, the other 2 charts on the right-hand side, the Dow Jones on top and the Russell 2000 on the bottom, those 2 actually have green backgrounds telling us that we do have a bullish posture using that market forecast intermediate term line. In the case of the Russell 2000, it's simply because the line is in the upper reversal zone. So notice that that line is traveling down, but because it's in the upper reversal zone, meaning it's above 80, then we still consider that bullish. On the other hand, it looks like the Dow Jones wants to start trending higher. Look at how far away the Dow Jones green line is from that upper reversal zone. It hasn't been in the upper reversal zone since the markets really started spilling over back here in February. Of course, they've had to deal with a little bit more issues with trade tariff talk and things like of that nature. So kind of a mixed bag. within our various markets right now, which makes things maybe a little bit more interesting and a little bit more fun. Maybe there's more trading opportunities because there are differences in our various indices out there. Let's take a look at our next chart now. And this is going to be our 3 green arrows chart. And so the color schemes are going to be different with this particular setup. What we're looking at here are 3 different chart background possibility colors. We've got green, which would be 3 green arrows, meaning the 3 technical indicators that we use to establish that particular trade signal would be considered bullish. Right now, none of the charts are green, and so we don't have to worry about that one. We also have white and we have pink. Well, in this particular case, let's look at the pink one, which is the Dow Jones in the upper right. What that's telling us is we have 3 red arrows. If we wanted to count them out, there's 1, there's 2, there's 3. So we have a red arrow, meaning we have price below a falling moving average in this case. We have a red arrow here as the histogram for the MACD went below the 0 line. And we also have what's known as a phantom red arrow on the stochastics here, where you see this slumping over and traveling lower within the upper and lower reversal zones. So Dow Jones from a 3 green arrows perspective actually is still our weakest component. And again, that's a little different too. You don't see that as often where you see from the market forecast posture setting perspective, Dow Jones had a bullish posture, and yet from a 3 green arrows perspective, you actually have 3 red arrows. Now remember, this can be reversed pretty quickly. We're hovering right around that moving average. So if the Dow were to go up tomorrow, there's a decent chance you could get a green arrow back on that moving average. So 3 red arrows in this case is not necessarily a warning sign of a huge storm in front of us. It's just a reminder that if you are using a trend trading system, that you have to obey your rules. Make sure you're moving your stop losses up when your plans call for it. The white charts here are just a mix of red and green arrows. We don't have all green or we don't have all red, and so those are considered more neutral. And again, the way that the S&P 500 is kind of traveling sideways right now, we shouldn't be surprised when we see that the 3 green arrows view here is showing more neutral types of views towards the market. All right, so now let's take a look here at our longer term charts, which will be a little bit more of a rosy vantage point, because remember, these charts go back 3 years in time, and each one of these candles represents 1 week in length, and therefore the trade signals are not very regular. If you're an active trader, you're probably not going to use this. If you're somebody that's sitting at home wondering from a 401k perspective, when is that time when you push money into the market and push out, then maybe this can be useful. And of course, this is not a recommendation. Nothing David and I ever say here should be viewed as such. We're not your financial advisors, but you can kind of see how that would have played out in previous years. Are there times where you have whipsaw action? Yes, there are. In the Dow Jones Industrial Average, you'll see we went from green to pink to green to pink. Now this is over a series of about 6 months, so it's not like you're getting seasick because this is happening over 6 days. But it does remind us that yes, you can get whipsawed in even these longer term types of strategies as well. But the good news for those of you that have been following this is that we are now 2 years into our anniversary, our 2-year anniversary of going bullish with this what we call 1040 crossover method. And the 1040 crossover method is just basically we're applying a 10-period exponential moving average to a weekly candle chart, and we're also applying a 40-period exponential moving average to a weekly candle chart, and we're just looking for crossovers of those moving averages. In this particular case, the way that I've got my chart set up, the 10-period is represented by this gold line, and the 40-period is represented by the black line. And so you can see that in all 4 of the charts' cases, we did have bullish developments or crossovers over 2 years ago. And I'd have to believe that most of you that made the decision to get into the market and not get out of it have been happy over the last 2 years. And so we're waiting in the wings to see whenever we're going to have that negative crossover or that bearish crossover, however you want to say that. But it's not up for us to guess, right? We can sometimes anticipate and prepare our brain and do things like that just to make sure we're okay with it. But in the end, the market's going to do whatever it needs to do. And a couple weeks back, I thought, oh, yeah, this is the time where maybe we could actually get the Russell 2000 to cross, and here we are. Life looks a little bit better all of a sudden, and the Russell 2000, both of those 10 and that 40 are now traveling higher again, and so that's a nice bullish development there. All right, let's now take a look at our sector 12 grids. And as a reminder, I do have to kill the camera feed here, so that way you guys can see all four corners of our screen here, as our charts will fill up all of this. And what we're looking at here is back to the market forecast way of setting posture using that green intermediate term line. And when you see pink charts, that means it has a bearish posture. When you see green charts, it means it has a bullish posture. So as mentioned before, the chart in the upper left is the S&P 500, and that does have a slightly bearish posture right now. But you can see that it's not all for naught, meaning that there are some positive areas of the market that we could focus on if we wanted to. And one of them, interestingly enough, is energy. Now, we'll get to it here in a little bit when we do our intermarket analysis 12 grid, but oil, as I mentioned in the intro today, really started spiking higher here today. And so that helped put a little pep in the step of some of those energy players here today. I noticed that ExxonMobil was not one of them. It's an integrated oil player, but apparently there was enough of the other players going a little bit higher. So let's just pop in Exxon real briefly there. Exxon was down 16 cents here today. Notice that Exxon has that bullish cluster that I mentioned in the intro as well. Remember, you get a list of those at the bottom of the emails for those of you that are signed up for our email distribution list. But it's had a number of these bullish clusters in recent months, and it really hasn't reversed higher. The good news is it hasn't really plunged lower. And so there is value to that. This was a pretty ugly and steep decline over here, and so it is good to see prices stabilizing to some degree. But I think a lot of people are waiting. Is it going to get up and through this moving average here or not? Well, if oil prices continue to trend higher, and if their compadres here within the energy sector itself continue to go higher, then maybe Exxon's got a chance at that as well. So energy is one of our bullish sectors right now. We've also got industrials as a bullish sector. We've got discretionary as a bullish sector. We've got telecom. We've got healthcare. We've got utilities, and we've got real estate. So a bit of a mixed bag there between cyclical and non-cyclical types of sectors that are out there right now. Again, the one that I kind of mentioned when we were looking at the indexes was technology here. Notice that technology did fall out of that upper reversal zone. It's at 78.98 and falling, so we just barely got a bearish posture on technology, but price on XLK is still above that rising moving average, so it's kind of maybe one of those make or break moments for technology, and it very well may need Facebook to stabilize in order to get us there. Otherwise, beyond technology, we also have materials, financials, and consumer staples as showing bearish market forecast postures at the current time. Let's take a look now at our foreign markets 12 grid. And here it's another mixed bag where we've got a few bearish ones, we've got a few bullish ones, almost split right down the middle there. We do have Brazil, Russia, and India within the BRIC nations as being bearish still according to the market forecast, but China, believe it or not, China is hanging in there. Its intermediate line is at 55 and rising, so that does enable it to have a bullish posture using the market forecast. And price has been reasonably impressive. It's not been roaring higher by any means, but I would have had to have believed myself, had I known the news that was going to come out regarding, potential tariffs and trade wars and all of this that's been in the news lately, that China would have been one of those that would have been negatively affected by it. But at least from a stock market perspective, its stocks have really not. And so China is actually kind of a bastion of stability right now, believe it or not. All right, so let's see what else we've got from foreign markets perspective. We've got Canada, Japan, Germany, and the United Kingdom as being bullish. And we've got Mexico, Australia, Israel, and South Africa as being bearish. But largely, these are a lot of sideways trending charts, just like the United States. And then lastly, let's do our intermarket analysis. I mentioned before, big story of the day, crude oil. Take a look at that move there in crude oil. Now, that is much to my chagrin. Some of you will recall I did a bearish trade on crude oil. Can't remember exactly what day it was, but it was a couple weeks ago, and so my bad, right? And that happens as traders. There's going to be times where we do things real well. There's going to be times where we don't account for things, and that's the life of a trader. So it does show that crude oil is moving its way higher. Now we'll see where this leads us, because we do have another level of potential resistance about where it's at right now. In fact, let me right-click on that and maximize it so you guys can see this a little bit better. But this was a nice 2.59% move higher today in crude oil. And you can see that it's lining up right in this area here where we had kind of this 2-day reversal back here in late February. So if we can get up and over that, I would say that's even more bullish for crude oil. Otherwise, there's just still that tiny little bit of hope out there for those that are bearish of crude oil, that maybe some sellers will step in that exact same area. So we'll keep our eyes on that story. But what we do know factually is that we now have a bullish posture on crude oil. You can see that green line has turned higher right there. We even have the moving average itself turn from red to yellow to green within just the last week or so. So that would generally be viewed as a positive sign as well. Somewhat interesting about that story with crude oil going up is that it did so in light of the fact that the dollar went up today as well. You'll notice gold was down today. So gold was down 0.5% here today. But if I right-click and maximize sell on the dollar, you'll notice the dollar was actually up pretty healthy amount today, 0.6%. So a lot of times you find that commodities will react negatively if the U.S. dollar goes up like it did today. But in the case of crude oil, it simply wasn't the case. And also keep your eye on the dollar here. It looks like it is trying to find some stability in this area. And remember, if the U.S. dollar starts trending higher, that's generally a bad thing for multinational companies in the United States, along with foreign ADRs and things like that as well. So right now, it's not a warning sign or anything like that. It's just it's kind of this, it's shaping this almost cup-shaped base here recently. So definitely not breaking down the way it was 3 or 2 months ago or so. All right, so that's what we had for you there today. And there you can see the rest of the charts there on our intermarket analysis. But what I thought we would do is take a look at SPY for our trade application example here for the day. Now remember, SPY is the granddaddy of them all. That's the oldest ETF. It was started in the early 1990s, and it's the largest, so it kind of had the first mover advantage as well. And the other good news is it's generally perceived as being reasonable in terms of fees. Remember, ETFs have fees the same way that mutual funds have fees. People don't always understand that because they think they're paying for a fee through a commission. Well, remember, the brokerage will take their cut in the form of a commission. Some of them offer commission-free trading for ETFs, but that's besides the point. But the ETF itself, the fund family, they've got mouths to feed, and so they are going to take a small cut as well. Well, the good news is fees are being driven lower as the years go on, and SPY's fees are generally perceived as being pretty modest. There may be some others out there cheaper from Vanguard or what have you, but SPY, one thing we do know for sure is that it's the oldest and the largest, and therefore it provides oftentimes the best liquidity if you are somebody that is trying to access the markets from an options perspective. And when you're going to do a trade like an iron condor, like I'm about to demonstrate here, liquidity is absolutely critical, because remember, the iron condor is going to have 4 different option strikes involved. And if you're trying to do that on an illiquid underlying security, you're basically amplifying the negative effect of each one of the strikes' illiquidity on itself 4 times over. And so in the end, you can really be up the creek, so to speak, as a trader, because you just have so much to overcome in order to be successful with your trade. With SPY, you oftentimes find that you're going to be able to have pennies or maybe 2 pennies between your bid and your ask. They are very, very tight spreads on all 4 of your strikes in many cases. And so let's go over here to the trade tab. And you can see why I'd be attracted to an iron condor here on SPY. Again, it's a largely sideways trending chop and slop market that we've been in recently. All right, I've kind of got this loaded up down below. I was looking at this prior to recording here. So I've got this loaded up down below, and you can see the 4 different strikes that I selected in this case. We've got a call spread and a put spread. So you can see that we've got call, call, put, put. And you can see over here in the quantity area and also where it says side, whether you're selling those particular contracts or buying those particular contracts. And so in the case of the call, it shows the 281 here, and it says -1, meaning that we're the sellers of the 281 call. But just below it, it shows that +1, meaning that we're the buyers of the 283 call. And so what we're doing is we're saying in that particular set, the calls right there, that we want the stock, in this case SPY, the ETF, to stay below 281. We're buying the 283. Some of you might wonder, well, why are you buying a 283 call then if you want it to stay below 281? Well, what we're doing there is we're buying a built-in insurance contract. If markets do what we do not anticipate them to do and spike, let's say they spike and let's say SPY is up at 290. For some reason, earnings come in great over the next couple months or whatever, and we're at 290. Well, if we've got the 283 that we're long as part of this particular trade, then we can cash in that contract and say, yes, we are now long. And so what that does effectively is it limits your risk to the upside. Yes, you're still taking risk between 281 and 283, but every dollar that SPY would go up beyond 283, you've got it accounted for. You no longer are seeing that risk on an incremental basis the way that you would if you had only sold the 281 call all by itself. And it's kind of the same concept down below when we're looking at the put spreads. Now, the put spread is a combination of a sold call, or I'm sorry, a sold put along with a bought put. And in this case, you can see again the -1 identifies the put that I'm selling in this particular setup, which is the 260, and the put that we're buying, the +1 right there, is the 258. So what we're saying on the put side of the equation is we want the stock, in this case, SPY, which is trading right around 271 right now, we want it to stay above 260. Now again, same thing. Why are we buying the 258 put? Well, that's just in case the markets get hammered between now and then, and markets start cratering. If we wake up and SPY is at 250, well, we're covered everything below 258. Yes, we take risk between 260 and 258. We still don't want that to happen, but it's not like we take incremental risk going lower. So that's kind of the idea there with the iron condor. In this case, we want SPY, which is trading at 271, to stay somewhere between 281 and 260. And so we're about dead smack in the middle of that right now, which is oftentimes how people set these up. And I did adjust things. A lot of times I'll look for a 20 delta, but the reason that I chose the 281 call in this particular case is if we come back here to the charts, let me just show you this. You'll notice that we had this brief period here on this candle where the high price was 280.41. So the original trade that I was looking at was 279, but I saw it was really close there, and I had a lot of return on risk to give up if I wanted to, because originally it was going to give me like a 45% return on risk. So I decided to give up some of that return on risk in order to have a little bit cozier of break-even points. And so our break-even point is going to be up here at about 281 now. If I wanted to draw those in, I could come up here to drawn items, going to drawing tools, and let's use this price level right here. So I'm going to click once here and kind of just drag it approximately where I think it would represent our break even. And so I'm going to click that into place right there. And then if I wanted to edit that to get spot on, I could right click on it. I could go to edit properties, and the value that I want to put in right here now in this new pop-up would be 281.46, because we're going to get 46 cents for the credit of selling that iron condor. And so if I click OK, then that line moves exactly to 281.46. And you can see now, in order for that side to be threatened, we'd have to bounce higher from here and go up and beyond where we were during this reversal period here. And then on the downside, we've given ourselves plenty of room. On our downside, remember our sold strike was down here at 260. So really, if we wanted to draw that line, let's do that one, 260, and then we're going to get a little bit of credit there. So our break even would be, let me right click on the line, go to edit properties, and our break even would be here in the value. It's going to be 259.54. Because again, we're going to take in 46 cents worth of credit. So technically, we can go a little bit below 260 even. And so we'll go 46 cents below that to form our line. And that's kind of our band of our iron condor. Now, we do have to be in this trade for a month. So remember, these are going to be the April contracts, which is expiring almost identically 1 month from today. I think the April contracts expire on the 21st of April. So basically a month from tomorrow. So if you're committed to being in the market for the next month and you're not certain on whether the market is going to burst higher or burst lower, and you think we're going to stay in this range, then maybe this is a trade that you could consider. So let me go back over here to our trade tab. And by the way, if you wanted to ever calculate what your return on risk is going to be, remember you can click on the confirm and send once. And we're just doing one contract for practice purposes here. So let's take $46, which would be our max profit, and divide it by 154, our max loss. And that would be a 29.8 return on risk, rounded up to be 30%. Otherwise, you could tick that from 46 cents to 47 cents if you really wanted to. I'm just going to leave it as is for practice purposes right now. So I'm going to send this in, and we'll see if we can get filled on that. So thank you so much for joining me here today. I hope you got some value out of some of the analysis I was doing here. Again, some of the big stories, Facebook continues to kind of pressure some of the tech stocks that are out there. We saw oil making kind of a random move higher here today, so let's keep our eye on that story, as well as what's happening with the US dollar starting to firm up a little bit there. But largely what we see is a lot of sideways action in the market. One way to take advantage of that is an iron condor, and we did it on basically the most liquid ETF on planet Earth there with SPY. So we'll see how that goes for us. So with that, I want to wish you nothing but success with your trades and your investments. David will be back with you tomorrow, and then I should be back in the chair on Thursday, and I'll look forward to that. So have a great night, everybody. Take care. Bye-bye.